Well, the NASDAQ closed above mid-vamp. That's good. That means all-time highs are in the near future, hopefully. We're still not above the previous high, but once we get up there, I think it's pretty surefire bet that we're going to hit all-time highs again. So we're back. We survived.
We are back.
We survived the great bear market of September 2nd.
Well, we have NFP tomorrow, so don't jinx us now, brother.
Yeah. But
But
yeah,
let's
I want to talk about gold because I feel like that's been on a lot of people's radar. It's just on an absolute tear lately. Didn't even tap Momo before doing this either. And I feel like what this is telling us is the Fed is walking into a policy mistake. That's the way that it seems like it's playing out to be. Like we've got strong growth, inflation still above target, inflation expectations rising still, and the probability of a rate cut in September is almost 100%. That just seems like a
right.
policy mistake. And we've got a whole newsletter written up on that. If you guys haven't read it, you should read it. Um, but yeah, that's what it's telling me. What do you think?
I think that's a very good assumption. I'm honestly, if you want to take this like on a simplistic view, gold is up pretty much every every single day since Jackson Hole, outside of maybe the last like day, right? Like Jackson Hole, gold. There's like that's not a coincidence.
Yeah, and it was because Powell was so dovish during Jackson Hole. So it just kind of like
Yeah,
solidified that rate cut, and I feel like that's just that's telling us right there that gold thinks that is a policy mistake.
yeah. Now, generally, gold does go up, but what's really telling me something is a rise. The way that gold's moving versus what bonds are doing, right? Like if we look at TLT, like since Jackson Hole, bonds are like flat, basically. Yet gold is way up. So I do think like look the and if we break this down, and we'll see NFP numbers tomorrow, but this is my labor thesis in a nutshell. I think that we haven't seen enough weakness in labor. If I were to tell you right now, and I were to just say, listen, the labor market isn't weakening, it would feel like I'm gaslighting you. Because if you look at what's going on in the labor market on a surface level, it's weak, it's slowing. The labor market is in fact slowing. So by me saying the labor market is weakening, or the labor market's not weakening, when it is weakening, it's just gaslighting you, right? Because it obviously is. But the dynamics of why it is weakening, I think, are misunderstood at the moment. I think the market is quite on the same side, right? Like it's understanding what's going on here. But I think the narratives are somewhat skewed because everyone's like, okay, labor's weakening. It's just about time. Labor market tomorrow. It's probably the most influential NFP print of the year because it's following Jackson Hole. It's following the huge negative revisions in August, and you're facing FOMC next month where they're going to release SEP, which will update forward guidance and give everyone the update and confirmation if either look the Fed is really going to continue cutting rates or it's going to be a cut and a pause. They can cut and then they can be hawkish in their SEP and somewhat basically push the market into the thinking like, okay, this was an adjustment cut. They're going to pause again. A lot of things can come out. How Powell describes this at his presser, a lot of things will really come to fruition here. And if the Fed does cut at all, so it's a very interesting a very important and interesting NFP print. But going back to what I was saying earlier with gaslighting, like I think that the labor market dynamics are just shifting in a manner where immigration policy on immigration is really impacting labor dynamics. You're looking at a situation right now where you can run the economy fine. Essentially, you can have an expanding economy with a lower payroll print without it actually being negative, meaning it seems like you can almost cut the payroll print from 150 in half to 75. If we had a 75,000 payroll print a year and a half ago, it was problematic. But I think now where we're gone with the labor dynamics, the economy doesn't need that 150,000 monthly labor print to really keep everything floating along. We can function at 75. And I think the big factor here will be how this translates to the unemployment rate. Where NFP goes tomorrow is one thing, but seeing the unemployment rate, let's look at the estimates here. So we're looking at, I think 75K is the street estimates for NFP tomorrow, but we can look at where the unemployment rate is, and that is going to be 4.3%. So the market's expecting a 10 basis point shift up in unemployment. And I think that how this translates, how payrolls comes in is one thing, and how it translates to the unemployment rate is another thing. If we have a blowout on payrolls and the unemployment rate's the same, or maybe the unemployment rate ticks down, whatever it may be, I think that all these are possible dynamics. Everyone's kind of written off this labor report as, oh, it's weak, it's cooked, the Fed's going to cut. But I really think that you're in a position where you may get a mixed report, you may get a really good report. No matter what the market price is in thereafter, by the time we get to the FOMC, I have a feeling that the Fed's going to cut regardless. I think they've backed this too much with forward guidance and Fed speak up to this point. Like, I'm betting that we shouldn't have an interest rate cut. I'm betting the economy is good enough we don't need to cut rates. But the way that they've given guidance via Jackson Hole and then further supported it through, supportive speeches and supportive commentary, I find it very hard for the Fed's lined up the cut. I find it very hard for them to walk it back unless like you get some absurd inflation print. But given, the unemployment rate within a 10 basis point band, coming in at 4.3 or 4.2, I don't think that's going to change the outcome at the Fed at this point. So yeah. I think that's where we really are stuck in between.
I agree with that. I think likely what's going to happen is they're going to cut and be very hawkish and say that they're going to pause afterwards because they do not want the market to run with it. Like, we are seeing inflation expectations rise already, and they do not want that to get worse.
I just want to follow this up, and this is a chart that I like to look at all the time. It's the economic surprise index, and we have this on our website. It's updated daily. But what this is it's a typical indicator that measures the surprise to the upside or downside of recent economic print. So if this is printing above zero, it's signaling, look, expectations are getting beat in a good way. If it's below zero, expectations are being beaten in a bad way, right? Less than expected, or negatively surprising. So I think that where we are right now contrasts to where we were in 2024. We were bearish on labor last summer. The SAM rule triggered, momentum was picking up in unemployment, and you saw payrolls drop, everything, ADP dropped, everything was looking spooky, and therefore economic surprises were actually hurting to the downside, right? Things were coming in way under estimates. People were scared. The Fed was even concerned, and we started getting that short but powerful rate cutting cycle where we reduced rates by roughly 100 basis points, right?
Yeah, we were actually saying the Fed is behind the curve back then, saying that they should be cutting more.
And I think that what has shifted is we expected there to be more transmission in labor momentum, right? And unemployment momentum, specifically that unemployment rate to really stay in motion. And the fact that it didn't was somewhat of an eye opener, right? You pretty much get to the point where you're like, okay, this labor market has much deeper resilience than many can really comprehend. And the SAM rule kind of exacerbated the issues because what the SAM rule is in short is it's always a momentum indicator of unemployment. You take the unemployment rate, you measure the change of it over a short period of time, and you're basically getting the change of the unemployment rate. So you're measuring the momentum in unemployment. And unemployment was at such a low place going into that rebound, that lift that we saw last summer, that it was very easy to shift it to put the transition to the SAM rule being active from inactive, right? You basically just had the unemployment rate lift something along the lines of like 30 bips or something like 40 bips, and boom, you're in the SAM rule. And that automatically spooked everyone on top of it because up until that point, it was pretty much uncontested that the SAM rule will generate a recession. At the same time that all this happened, the economic surprise index, this only goes back little over about a year, but it was negative by like negative 30 points or something like that. So sentiment was complete garbage. Economic events were printing under expectations. Everything was surprising to the downside. It was not a good environment. It was, the onslaughts or fear of recession were a thing. Fast forward to today, where we're talking about labor market, the most influential labor market of the year, given that it's preceding the whole rate environment, or the rate decision coming up, right? You have a situation here where there's going to be a decision on rates, but you're anchoring it off the fact that everyone's spooked about these large negative labor market revisions, but the underlying data is still coming in okay, actually very good. Like, we're still surprising quite well to the upside compared to what we were used to seeing. Like, if this was at negative 30 again, I'd say, negative territory, I'd say data is just mixed, but leaning to the downside. The fact that we're where we are on the surprise index is almost like a signal to me that says, okay, there's a good chance here that maybe labor surprises. Like, when this index is positive, my base case tends to be, okay, data's a toss-up, but expect like good data. Expect things to continue. Markets and economies have momentum, so expect things to be okay. And if that's the case, then this labor print shouldn't be terrible. And if that's the case, then you're facing a situation where last year we saw this, where labor slowed into the end of the summer and reaccelerated into the fall. If that is to happen now, you're going to basically throw a wrench in the whole cutting cycle again. And I think that's the risk that we need to accept and understand right now, that look, like, the economy is not as weak as I think most people would like it to be, because I think there's a general consensus that people just want lower rates if it's for their portfolios, thinking they're going to refinance their house, whatever it may be. People just want lower interest rates, and they'll cling and point to anything that they can to warrant and merit lower interest rates. But things aren't nearly as bad. I mean, we're talking about last quarter's GDP being plus 3% and Q3's GDP estimating to be at 3%. So you're talking about back-to-back plus 3% GDP, real GDP quarters. You're talking about inflation that's sticky and above trend, which is a signal within itself that the economy is in a state where capacity isn't constrained. And you don't want massive rate cuts when capacity isn't constrained, because all it does is reaccelerate inflation. And I think that's the risk right now, the inflation risks, not so much the growth risks.
Why do you think the market is so much more productive right now? Why do you think lower NFP numbers aren't a cause for concern, because it's not affecting growth?
Well, I think when you have the policy changes to immigration, where you're essentially, cutting the supply of workers in the workforce, right? You're essentially shifting the supply and demand dynamics in the labor force by removing people from the workforce,
Like
and preventing new entry.
removing like weak workers in a sense, and now there's only like high productive workers remaining.
No. So, like, immigration influxes as people come across the border, right? They need jobs. You basically have this influx of demand, right? You have unfilled jobs. You have new people and I'm not talking about illegally, however you want to put it. You have this huge surge in immigration. You want people to find jobs. It increases the supply of labor, right? And what happens in reverse is you take supply of labor out of the workforce, right? There theoretically can be more jobs per person, right? And there's more supply. So it weighs on the unemployment rate when you do it in reverse.
Right.
Massive immigration can lift the unemployment rate, but a pause in it or reversal can weigh on the unemployment rate. Now, what this translates to is an environment where you also don't need the same number of jobs or same number of economic growth to sustain the population growth, because the population growth is slowing, right? The net population is obviously not rising fast, or rising as fast as it was, because you have a slowdown in immigration. And that weighs on labor dynamics. So now if you take a step back even more from that, you look at this and you say, okay, well, if immigration policy is weighing on the ability for the unemployment rate, like, for example, simply put, If we were getting these NFP prints without the immigration policy in place, unemployment rate would be much higher. The unemployment rate is telling you there's a disconnect between NFP and unemployment. And that disconnect is immigration dynamics. That's what's causing the disconnect. So if immigration dynamics are allowing for a lower pace of job growth and keeping unemployment the same, we can't get too concerned about lower payroll numbers. Obviously, negative payroll numbers outright are bad regardless. There's no there's no illusion there. You're taking jobs out of the market, right? Could it be masked by intense immigration policy, like outright authoritarianism? Yeah, sure. But that's not a dynamic we need to talk about. I think that the shift we're seeing, we can run an economy at lower monthly payroll rates without really damaging unemployment. And what I want to tie this back to is the Fed's estimates have been for median unemployment at like 4.5%, right? We're at 4.2 and we have what, September or August? We got September, October, November, December. We have 4 more months.
Yeah, so
and the
pretty
median
much,
the median for this year was 4 I think it was 4.5.
yeah. So pretty much unemployment can go to like 4.8 for the rest of the year, and we'd still be on track for what the Fed expected.
Right. Which I think that these labor dynamics are just hard to gauge. And you brought up a question earlier about growth, right? Like, what is growth doing? What's the trend of, like, why is growth able to chug along the way it is, even with these lower payrolls? And I think the dynamic there is quite simple. Look, you have an economy running above capacity by default, right? If you measure growth and potential, we are above potential. So the CBO can estimate where the potential is based on the economy's capacity. So this is what the CBO does, is they measure economic capacity. How much growth can the economy do at maximum capacity? Well, our growth figures are above that number, which is fine. It happens. This is the cyclical part of economies. We can go above and below potential. Now, you don't get a recession above potential. You get a recession below potential because the economy is running under capacity, right? Very simple understanding. If you're running under capacity, you have a shortfall. That's typically a recession. So we're above capacity. Now, the shifts between above and below capacity can happen quick. It doesn't mean like, just because you're above capacity, you're golden. But the problem here is the Fed. We're above capacity, and the Fed is much closer to neutral than they should be. In theory, the Fed is about to embark on a cutting cycle, and there's a risk of them giving even more dovish forward guidance, when in reality, the reason that growth isn't falling apart, the reason the unemployment rate isn't ripping, the reason inflation isn't at trend is the Fed has lost some grip on. They were restrictive last summer. If they were still at that level, they would still be restrictive. But they're more at neutral than they are at restrictive. I wouldn't even call them moderately restrictive. I'd say the Fed is probably at neutral. And I'd say actually the Fed is running the risk of going below neutral and actually becoming accommodative in an environment with an economy that's running above capacity. And when you do that, when you become complicit and say accommodative in an economy that is not constrained, it's above capacity, it's running above capacity, that is just that's just a match and gasoline for inflation, right? You're just keeping inflation running because that excess demand has nowhere to go. When your rates are modestly restrictive or restrictive, right, in an economy above the neutral rate, what you're doing is you're dampening demand, right? Because you're keeping money, you're preventing increases in money velocity. You're preventing people from spending money. You're keeping money locked up in cash equivalents, right? You're trying to slow the velocity of money. And if the economy is above capacity, you want to really do that because that excess money has nowhere to go. You can't produce more goods. The goods capacity is at a certain level, and it can't really go beyond that. So all that excess money is chasing finite number of goods. It bleeds into inflation. That's why being restrictive in an economy above capacity is so important. So if the Fed decides to go dovish, too dovish, and become basically accommodative to an economy that's not under capacity, you're going to see this more of this flow into persistently higher inflation. I'm not talking 70s. I'm not talking hyperinflation. I'm saying it's going to be harder and harder to get inflation down, down towards that 2% target than it already has been. We had this nice wave of disinflation. The Fed was moderately, you can argue, restrictive, if not restrictive, at least moderately restrictive. And there's a reason inflation fell to 2% quite quickly, roughly 2.5%. And there's a reason why it hasn't gone lower. And there's a reason why it's showing signs of struggling even more now. And that's because forward guidance has already bled into the market.
Yeah.
Of
and
being obviously dovish.
Along with that would go asset prices. As long as inflation doesn't get too crazy, if we go back to 10% inflation like we had before, yeah, that's going to cause problems. But if we stay at around 3%, 3.5% inflation with an above capacity economy, that's going to be very good for risk assets.
So this is the thing that everyone needs to understand when it comes to inflation and it comes to risk assets, because you're actually bringing up a wonderful point. Like, if we have inflation, risk assets should go up. And the reason risk assets go up in inflation is only when inflation is not deemed problematic. So in your example that you brought 10% inflation, the reason why risk assets likely don't go up at 10% inflation is the Fed has a level of independence where they will actually act on that, right? They will essentially hike into, like you saw that in 2022. There's a barrier where the Fed will not ignore. It's when the central banks ignore inflation. Think of any of these like central banks, any of these debt crises across these central banks or call them currency crises. It's when the central bank ignores the inflation and they print to oblivion. That's when you get the actual melt up bubble where literally everything melts up because the denominator is getting devalued to nothing. And what the Fed has made clear here is while they do have a 2% long-term inflation target, after Jackson Hole, they've gotten very comfortable and very flexible with that, where that target is going to be met, right? They've essentially loosened the reins a bit, saying that labor is more important than inflation. And quite frankly, the Fed is always going to make that decision. The Fed is always going to prioritize labor over inflation. The reason why the Fed was able to do what they did in 2022 was because labor never cracked. Labor never imploded. If the unemployment rate would have gone to 6%, the Fed would have started cutting. And the reason for that is labor shocks are deflationary by nature. So the Fed is very concerned about labor more so than they are about inflation, to the point where as soon as labor shows signs of cracking, the Fed is going to, like you're seeing it right now. Negative revisions to NFP. NFP is not even negative, right? You're talking about just negative downward revisions. NFP is still positive. Expectation is still positive. Unemployment rate barely changed. But the idea that unemployment could start reaccelerating up has everyone spooked. And inflation is low enough in the 2% range where they could shrug it off. If inflation was 8%, the Fed would have to be a bit more diligent with how they're conducting policy. But because inflation is low, it's a write-off. It's like, oh, okay, we'll just prioritize the labor market, because at the end of the day, having a country with no workers is worse than having a country that's to deal with inflation that's 50 basis points above or 75 basis points above our target.
Yeah,
and that's the battle.
The deteriorating workforce is just going to solve the inflation problem as well.
Right. And I think that the Fed has this very, very soft and numb spot, or call it weak spot to inflation. Weak spot to labor, where if the dynamics are somewhat similar from last year, and those dynamics persist, where you have this economy that can kind of go through these ebbs and flows, and immigration policy that's also distorting the picture, making it very hard to see what's coming. If that does persist, the Fed is almost going to get fluked dovishly to the downside on a consistent basis, where you get these windows of weakness in labor and the Fed gets all scared. Maybe they put a cut or two on the table. They do reduce policy rates, and then you get this reacceleration phase where that's even fueled additionally by the Fed bringing that restrictive level lower and lower and lower. right? They're just getting easier and easier and easier into an economy that's not actually deteriorating at the end of the day. And that's the dynamic I think at play here, which, I think most people will just call for rate cuts because they want their stocks up and they want their mortgages down, right? The rate cuts. But in reality, if you look at it from like, why are we cutting interest rates? Are we forecasting weakness? Are we doing it because the last number spooked us? Like, why are we cutting rates? And this is where the SEP, I think the update will give us an idea of where the Fed is seeing some of these dynamics shift in the next quarter, right before their next one, but which would be December. And I think that how this NFP print comes in, how the market takes it, will give us the indication as to, okay, is the Fed really going to make a policy mistake here or not? Like, if odds shift, if the NFP print is good and odds stay pinned at a cut, then you kind of have the idea that, look, okay, it doesn't really matter what NFP could have printed, the Fed is going to cut regardless, which solidifies that policy mistake. But if they do move, then maybe we have a more of a toss up at the meeting later this month. Thank you guys so much for listening. If you have any questions, feel free to go to our website at market-radar.com, or you can reach us on X at the Market Radar.